U.S. President Donald Trump says he has struck his biggest trade deal yet, and he's agreed to a trade framework with the European Union.
We've reached a deal. It's a good deal for everybody, I believe.
The United States and the European Union have agreed to a new trade framework. At the center of it, a 15% blanket tariff on most European goods entering the U.S. pharmaceuticals are exempt. But steel and aluminum from the EU will still face the steep 50% tariff imposed under national security provisions. In exchange, the EU committed to $750 billion worth of energy purchases from the United States and pledged $600 billion in new investments. They also agreed to significant defense procurement, although no figures were disclosed. This deal is not a binding treaty. It's a framework, announced just days before a 30% tariff was set to take effect. That timing wasn't accidental. It followed the same pattern we've seen in other Trump-era negotiations: pressure, then deal.
$750 billion worth of energy. To agree to invest into the United States $600 billion.
It's 15% tariffs across the board, all inclusive. The investments Mr. President just described, and the purchases over there. Indeed, basically the European market is open. It's 450 million people.
This isn't a one-off. We've already seen similar structures in deals with Japan, the United Kingdom, and Vietnam. In each case, Trump threatened steep tariffs. Then, after days or weeks of speculation, a framework was announced, usually built around a 15% baseline tariff and large-scale investment or procurement from the foreign side. This model flips the trade conversation. It's not about removing barriers. It's about creating predictability and charging for it. Trump's 15% now feels moderate, simply because the alternative he threatens is always worse. That's not trade liberalization. It's transactional stability. And the pattern is clear. Allies, competitors, everyone pays. Now, all eyes turn to Canada. A 35% tariff is scheduled to take effect on August 1st if no deal is reached. Ottawa has made it clear. The deadline is political, not legal. And they won't be rushed into a bad agreement. But the EU and Japan were longtime US allies too, and both had to accept Trump's terms. Canada knows that. And while it hasn't signed any framework, it's not sitting idle. Canada brings leverage to the table. Over $1 trillion in investment into the US, a deeply integrated energy and auto supply chain, and decades of cross-border ties with key American states. Alberta's oil, Ontario's parts plants, these aren't abstract advantages. They're real points of influence. Carney's government is watching the sequence, not resisting it. The strategy isn't to be first, it's to be smart. The federal government has already moved to manage public expectations. Early promises of a good deal have shifted into a more realistic message. This will be about managing trade-offs. The lessons are clear. No country has secured full exemptions. Baseline tariffs are now the floor. And rushing into a vague framework, like what Japan and the EU accepted, might avoid pain in the short term, but lead to problems later. Instead, Ottawa is preparing, working with provinces, identifying sectors that need shielding, and exploring room for targeted offsets. Trade diplomacy is still happening, just not on Trump's schedule. Trump's trade system isn't built on trust. It's built on leverage and price tags. But that doesn't mean Canada has to fold. It means Canada has to design, shape a deal that protects what matters most, whether that's auto, energy, or digital trade. The real danger isn't delay, it's giving in too early for too little. In this new world, the countries that hesitate might get hit. But the countries that rush, they might get locked into terms they regret. And Carney knows, better to sign the right deal late than the wrong deal too soon.
Term thing. China's influence on the world stage has been growing and America's has been declining. It seems to have accelerated in the last few months.
Trump's tariffs were supposed to make America stronger. Instead, they've exposed just how much leverage the country has already lost, not only in global trade, but in global leadership.
The numbers for the full year should have gone up. But because of tariffs, companies withdrew their guidance and left to their own devices. Wall Street cut numbers for the full year, expecting tariffs were going to take a big bite out of business.
President Donald Trump returned to office promising to finish what he started: break global trade dependencies, revive American manufacturing, and force allies into reciprocal trade deals. His signature weapon? Tariffs. On April 2nd, what he called Liberation Day, the administration announced sweeping tariffs of 10 to 50% on over 100 countries. Canada faced 35%, the EU 30%, China 50%. But instead of forcing trade partners to fold, the strategy is falling flat. According to Morgan Stanley Investment Management, U.S. companies in Q2 2025 showed stronger than expected earnings. Not because tariffs helped, but because Wall Street had slashed expectations too sharply earlier in the year. Companies had withdrawn guidance out of caution, assuming tariffs would bite deep. But those fears didn't fully materialize. What did happen? Supply chains rerouted, costs shifted, and a wave of confusion left investors cautious. Tariffs didn't crash the markets, but they didn't boost domestic production either. Industrial growth remains sluggish. Input prices have edged up. The economic logic behind Trump's strategy is now under serious scrutiny.
I think that's right, Ali. Exactly right. I think if you were to look back at public opinion polling from the first Trump administration, you would also have seen the gap close between the United States and China on the global stage.
Well, China is the world's largest producer of steel, of aluminum. They produce 2/3 of the world's electric vehicles.
While the economic results remain mixed, the geopolitical cost is becoming crystal clear. Longtime allies are walking away, not in anger, but in quiet disappointment. European officials now describe the U.S. as an unreliable partner. Trade talks with the EU have stalled. Japan and South Korea are signing independent energy deals with Canada, bypassing Washington. What's more, Trump's foreign policy choices, cutting USAID funding, slashing international education programs, and walking back diversity initiatives in universities, have eaten into America's soft power. According to Freedom House, the number of democracies worldwide has declined for 19 straight years. Trump didn't start that trend, but analysts say he's accelerating it. U.S. influence used to come not only from the dollar or the Pentagon, but from trust. That trust is eroding, and nothing is replacing it. As Washington raises walls, others are building bridges. China, once hesitant, now responds with full confidence. In April, Beijing imposed retaliatory tariffs as high as 84% on U.S. goods. It restricted rare earth exports, tightened import licenses, and deepened Belt and Road investments. Over $1 trillion has been pledged across Asia, Africa, and Latin America, with little U.S. competition in sight. Even more striking is Canada's response. After being hit with 35% tariffs, Ottawa didn't just retaliate with its own 25% levies. It went further. Prime Minister Mark Carney launched an economic realignment strategy, boosting trade with Mexico and the EU, slashing exposure to U.S. supply chains, and coordinating regional alternatives. Tourism from Canada to the U.S. dropped over 40% in June, according to international booking platforms. Some provinces banned American alcohol from public events, and Canadian consumers, quietly, began choosing differently. Trump's tariff-first doctrine was designed to project power. But in practice, it's revealed a painful truth. Power doesn't come from shouting louder. It comes from being needed. And in 2025, more nations are showing they can walk away. China is no longer waiting for U.S. permission. Canada is no longer asking for exemptions. Allies are looking elsewhere, and they're finding options. What Trump promised as strength is starting to look like isolation, and the world is moving on, with or without the United States.
Canadian Prime Minister Mark Carney says a proposal for a new oil pipeline in Canada is highly likely.
Look, the bottom line is a new east-west coast pipeline in Canada is good for Canadians. It's good for world markets in that we have access to more supply.
But for the first time, Canadian liquefied natural gas is heading overseas.
As President Trump ramps up tariffs against Canada, Ottawa is responding, not with speeches or countermeasures, but with something far more strategic. For the first time, Canadian liquefied natural gas is being shipped directly to Asia, bypassing the United States entirely. At the same time, a new cross-country pipeline is being fast-tracked. It's not retaliation, it's leverage, and it could reshape the balance of power in North America's energy and trade relationship. In early July, Canadian Prime Minister Mark Carney confirmed what many had suspected. Canada is moving ahead with a proposed pipeline connecting Alberta's oil fields to the Pacific coast. This east-west pipeline would allow Canadian oil to bypass American refineries entirely, a strategic shift at a time when U.S. tariffs are rising. According to former U.S. Energy Secretary Dan Brouillette, Canada's push is more than economic. It's political. With American refiners buying most of Canada's oil, the country has long been boxed in. This pipeline could change that. But oil isn't the only focus. In British Columbia, LNG Canada has now shipped its first cargo of liquefied natural gas to North Asia. The $40 billion project, the largest private investment in Canadian history, has capacity for 14 million tons annually, and it could double. Suddenly, Canada is no longer just exporting energy to the United States. It's entering the global market.
Well, as you know, it addresses two key priorities for the Carney government. One, trade diversification, which is the new mantra in response to Trump's tariffs. So it fits into that. It also fits into the other objective of Canada becoming an energy superpower.
Why does this matter now? Because nearly 97% of Canada's oil and gas exports still go to the U.S. That's been a long-standing vulnerability. It means lower prices, less production, and no access to rising demand overseas. But LNG is shifting that. Asia now accounts for over 70% of global LNG demand. Countries like Japan, South Korea, and China are looking to cut coal use and need reliable natural gas. Canada, with its Pacific coastline, has a key advantage. A tanker from British Columbia reaches Asia in half the time it takes from the U.S. Gulf Coast. That means Canada can compete and win. If this shift continues, Canada could significantly reduce its reliance on American buyers. And in a trade negotiation, that matters. It changes the power dynamic. Because if Trump continues to use tariffs as pressure, Canada now has an option. Redirect supply away from the U.S., not just in theory, but in real volume. This is no longer a bluff. It's infrastructure in motion.
North Asia story. The project comes as Canada looks to diversify its trading relationships outside of the U.S.
The United States might be the world's top oil producer with a record 13.4 million barrels per day in July 2025, according to the Energy Information Administration. But production is only one part of the equation. Delivery is another. America still faces challenges building the pipeline capacity needed to move that oil. It also relies heavily on stable imports from Canada to balance refining needs, especially in the Midwest and Northeast. If Canada cuts or diverts supply, U.S. refiners could face higher costs. Consumers could see higher fuel prices. Even more, industries tied to energy, like electric vehicles, heavy manufacturing, and construction, could feel the pressure. Canada's new LNG routes, if fully scaled, could also undercut future U.S. export ambitions. While the Trump administration promotes its own Alaska LNG project, it's years behind. By the time American gas reaches Asia, Canadian cargo may already be there. Trump's tariffs were meant to corner Canada, but they may have pushed it to finally break free. Pipelines and LNG terminals don't respond to tweets. They reshape long-term leverage. And this time, it's Canada laying down the infrastructure, not just the rhetoric. As natural gas flows westward and oil bypasses old routes, the question isn't whether Trump will escalate. It's whether the U.S. is ready for a trade war where energy is the counterpunch.